And our next guest says the Fed's expected rate cut next week won't be the catalyst for cyclicals to start to outperform. Joining me here at Post 9, it's Chris Verrone of Strategas. Chris, good to see you.
Great to be here.
Yeah, I think it's a bit of conventional wisdom, right? That it's sort of Fed cuts rates, maybe it's a soft landing, maybe it gives the economy a refresh, and why wouldn't you buy cyclicals? So what does history and your work say?
Well, I think it's an example of there are so many things in this business that intuitively sound like they make sense. The Fed cuts, cyclicals are rebirthed, and they resume as leadership. That's just not what the data has said historically. Particularly, the non-recessionary rate cuts have not recatalyzed some cyclical trade. I think 95 is a great example. They went July 5th of 95 was the first cut of that cycle. Tech struggled for the next 6 months. So if you think of that as kind of the flag holder of cyclicality, but you also had consumer discretionary week. Now, Walmart was part of the sector then, so perhaps a little bit different. But what did work? Staples worked, healthcare worked, Utes held up okay, REITs did well. So there is a kind of a counter-cyclical streak that runs through leadership regardless of why the Fed is cutting.
Yeah, I mean, not to go step by step through the history, but I do recall, I mean, the Fed cut in 95, but in the middle of that year, I think the economy, GDP was kind of stalling out, right? You had like a sub 1% GDP quarter or something like that. In other words, there's a reason that they're moving. I guess the question is, as you look at the way the market's acting right now, the leadership profile shifting around, is there any way to tell when we just have this, oh, that's the way it acts when we get a non-recessionary rate cut, that's the way soft landings behave, or is it the market flagging more weakness, a further downturn?
Well, I think,
risk?
Mike, what's important about the leadership is this isn't 2 or 3 or 4 weeks in the making. I mean, this has been the leadership that's been developing in the last 4 or 5 months. I mean, utilities have been inflecting all year. The REITs have been inflecting all year. Healthcare more recently starting to improve. What do all of these have in common? I think very rate sensitive.
Sure.
And, you know, I do think, as I've told Scott before, I think there's a difference in this business between fighting the tape and fighting the consensus. I never felt like we were fighting the tape on rates this year, but I did feel like we were fighting the consensus at times. We still like them lower here. Yeah. And I think the leadership reflects that.
Like, for example, 10s lower to where?
Under this basically 370 neighborhood, which is where we are today, there's really nothing beneath you until about 3.25. You could even make a case 290 or 3% is kind of ultimately what the final destination is. I think going back to that 95 analog, what's notable is when the Fed started to go, remember, rates had already been falling in advance of that. They bounced for about 6 weeks, and then they resumed lower. It was not until the final cut where bond yields actually bottomed in early 96.
You mentioned technology, certainly back then would have been considered this really leveraged cyclical boom-bust type of a part of the market. Now, dominated by these kind of monstrous platform-type companies, it's been kind of defensive. But either way you slice it, it feels as if they've kind of broken stride in terms of their leadership.
Well, it's been piece by piece. Yeah. I mean, these semis, put NVIDIA aside for a moment, the average semi has really not been a leadership stock this year.
Like
and I think, right. And I think when you break tech into kind of two pieces here, you have cyclical semis, and then you have, in some respects, the very large Mag 7 type names that were kind of almost viewed as bond substitutes when you couldn't own bonds. So if we can own bonds here, do we need to own those bond substitutes? And at the same time, it does seem like everywhere cyclicality is under some pressure. It's probably more overt in Europe, where I think tech has broken harder. ASML is the largest weight in the European tech index. That has broken hard here. But really, everywhere you look, this is a pretty consistent leadership message around the world.
And then what about financials? We can define them, you know, in whatever bucket we want, but they're obviously, you know, backing off today, but have been improving.
Yeah, they've been leadership in our work really all year. I think it's really essential that continues. They're certainly weaker today. I think the trends are good enough where you would want to be a buyer of an oversold condition in financials as it develops. This is a weak seasonal period, as we know. Financial sector seasonality really starts to get better come late October, early November. I think it's essential they respond out of that affirmatively. And you got to go back again to that 1995 period. What is the one dominant leadership message? Financials roared out of those 95 cuts. So if we're going to maintain what I think is the status quo of soft landing, I think it's essential you keep financials involved and credit conditions benign.